Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win. Hi, this is Mike Maloney, and I've got my guest Tavi Costa with me once again from Crestcat Capital, and they just released their latest newsletter. Tavi, how are you doing?
I'm great, Mike. How are you?
Excellent, excellent. So you've got another newsletter, and the newsletters are sort of generally have the same message to them, but you present different information each time that bolsters your case. So you've got quite a number of charts there, and I've picked a few of them for us to run through that sort of have a common theme. And so could you run through them for me here? The first one you've got is U.S. Treasuries are now more volatile than gold, and that's pretty amazing.
Yes, it is. And it's, it starts from this whole idea. We all know, both of us, that central banks have been accumulating gold. And, when you think about large portfolios, there's two types. There are central banks and there are 60-40 portfolios. And 60-40 portfolios mostly focus on the 40% is that's downside volatility, is that risk of a recession, and how do you protect your portfolio? And for them, it's important to have U.S. Treasuries as part of that 40%. So when you see a chart like this, which shows essentially that Treasuries are now, for the first time in 45 years, more volatile than gold, that changes the whole setup of how do we approach portfolios overall, and the fact that we've been under allocating towards the metal for really many decades now. So in my opinion, this is absolutely critical for that change.
Yeah, the underinvestment. I mean, everybody was chasing yesterday's news in the previous bull market of the 70s, and really the public came rushing in 79 and 80 when gold was made, and so there was a heavy allocation during and after the peak. And so it was in the 90s where the allocations of the typical portfolio had a lot of gold in them, but by 2000 there was none.
That's right.
So, and it's been close to none since. I believe it's less than 0.5% of financial assets are allocated to the precious metals now.
And Mike, if I would have a drink for every time somebody tells me that it's great to get 5% yield on cash, it's insane how many people are of that view. And honestly, I think this is, sort of painting a picture, a perfect storm for gold to outperform not only cash but Treasuries overall, and make everybody, look kind of stupid for holding cash. And This is, to me, it's a good setup for right now. So
so run us through the next chart, which so we've got gold versus the 10-year real yield. So we were comparing gold to Treasuries before, and this is gold versus Treasuries, but it's the real yield, and something has happened.
That's right. Something has happened, and certainly that has, brings the question. And you asked a question before even we start recording. It doesn't mean gold needs to fall or the red line needs to rise. And I think, to me, the meaningful part of this chart is that it really reflects a change or a shift in macro regime. This is precisely when inflation
and investor psychology.
There's absolutely right. Yeah. It's when inflation really started to get out of control, when the Fed had to step in and shift their policy. It's when cost of capital began to also stay historically elevated. It's when value began to outperform growth. I mean, there's so many things that occurred during that break of that correlation. Unfortunately, a lot of investors are seeing that as something cyclical that will go back to those times. And we would go back to the 70s when we had inflation hit higher than historical norms. What we saw during that time was that 10-year yields were rising despite the fact that gold was rising. In fact, in locksteps, I mean, they are positive correlated, which is the complete opposite of this chart. So,
right, we need to point out for the audience that the red curve, the 10-year Treasury real yield, is inverted.
Mhm.
on top of a normal gold price. And so it's even though they line up so well, it looks like they're completely correlated. What it is a correlate. Correlations go from +1 to -1. And this is like a minus 0.99% correlation until 2022.
That's right. And it begs the question, are we in a structurally inflationary period? And, we believe we are. I think we're going to touch on that in a second.
Yeah.
And, just going back to the 60-40 portfolios, do you want to make a comment? Sorry.
Yeah, I want to make one more comment on that last chart.
Yeah, absolutely.
That I think psychology switched in 2022 when inflation changed.
Mm-hmm.
And basically, you can have the correlation of the inverted yield up until 2022. And then you just have to take in your mind that falling red line after 2022 and invert it and paste it onto the chart.
Yep.
And so gold has to catch up with this. There's a big spread there, and it's due to the psychology of what's going on. So anyway, yeah, go on to your 60-40 chart.
I couldn't agree more.
Thank you.
The history of 60-40 portfolios is important to put into perspective. And so now, how much do we earn as a yield when we hold a 60-40 portfolio? That's what this chart is basically representing. And you can see the white line goes up and then down and up and down. And there are times when 60-40 portfolios are historically undervalued. Those are times like the beginning of the 80s, which was the end of a stagflationary period, or the very bottom of the Great Depression, or the beginning of the Roaring 20s. And then you have today, where we are on the other side of it, historically overvalued for bonds, but also for equities. And, if we're going to see an upward movement of this, I believe we're going to go through a restructuring of 60-40 portfolios. And that means we're going to just hold a more, we're going to rebalance those portfolios and hold a more balanced number of assets. And gold will likely become a large percentage of those traditional ways of investment strategies.
I've got an untraditional 60-40 portfolio. 60% is silver and gold, and 40% is everything else. So
that's one way to do it.
let's move on to the next two, which can be covered very quickly because they correlate quite well. So tell us about these. And I believe you are exactly right on with your "you are here" arrow.
I hope we are right. And I think we are as well. So, it's interesting how policymakers and investors have been neglecting an important lesson throughout history, that inflation happens through waves. And we've seen this in the 70s, as you can see in this chart. And, it's just math. We see prices go up, and then the year-over-year change of a price after it goes up a lot, and you kind of see that deceleration process. We've had that already. We're now in the process, likely, of a bottoming period for consumer prices. And when I show this chart, initially, a lot of people would say, yeah, but this is not the 70s. This is more like the 40s. Aha. Well, here's the next chart. 30s and 40s also went through 3 waves of inflation. And then, to me, this is, if I was a policymaker, I would certainly have that on top of my agenda in terms of how to approach inflation overall. And unfortunately, I think, if anything, what we're seeing is, absurd fiscal stimulus and still a way of managing, the whole macro economy right now, in which I think hard assets are going to become more and more favorable in this environment.
Yeah, well, there's the hard asset cycle too, commodities versus equities cycle and commodities are so incredibly undervalued compared to equities right now historically that it supports all of these other charts that you're showing. So let's move on to the next one.
Yep, and the next one is a compelling case.
Yeah, we're finally at gold.
Let's talk about gold now.
Gold. That you're comparing an economy that's been in sort of a stagflation for a long time.
Yep.
And we are going into, I think there's going to be more printing and so on. And so, so tell us about this. Sorry.
No, this is a roadmap, right? It's a compelling case for developed economies that have been facing what I think it's a chronic debt problem with embedded inflationary issues. And they're very structural at their nature. And so what happened with Japan is the red line. The red line is gold in yen terms has been surging to new highs. And you look at that relative to gold in USD terms or US dollars, you can see that there's a lot of skepticism, but likely we're going to go to the same path. Japan itself has about 255% of debt to GDP on the government side. The US is about 120. And not thinking we're not going to go to 250 in the US seems to be absurd to me. So no, but that is the roadmap in my view, and why we're going to see that white line follow the red line. So this is absolutely critical if you hold gold or if you're considering to do so.
Yeah, you mentioned central banks a while back, and what amazes me is the central banks, especially the Eastern central banks, China and India and Turkey and Russia and so on. There's an accumulation of gold that is sort of counter-cyclical to what the public in the West does. Mm-hmm. And it's like, are you going to be on the side of the biggest smart money in the world? And over time, they win. These gold going sideways or down is just an opportunity for China to accumulate more. And I look at it as my opportunity to accumulate more as well. You want to wait until you want to accumulate and wait until something breaks. So, yeah.
Yeah. And to your point, this is the history of gold cycles where, I kind of listed the first and the second and the third cycles that I think we're into a third one, but the first and the second, and I listed some of the reasons behind it. And yes, we're in an inflationary era. Central banks were accumulating gold at that time, very similar to now. There were a lack of discoveries of gold across the major companies and miners overall. And production of gold was falling as well. So the second cycle was interesting because production of gold was also falling across most of the major companies. But we didn't see central banks buying gold as much as we see today. And what happened at that time was that China was entering the WTO and becoming a global manufacturing plant. And we saw a construction boom that drove commodities. And so today, if you ask me, I don't think we've ever seen so many reasons to be long gold. And skepticism is in a level that I don't think we've seen before. Lack of discovery.
That first cycle, the 70s, the reasons basically were inflation, oil embargo, and there was a Gulf War going on.
Yeah,
and we had just become a fiat currency for only 8 years, and there was a distrust. Today, there are so many imbalances. We've got all of the same reasons that we had in the 70s, plus another list that's like another 20 bullet points long.
I mean, the deficit, it wasn't an issue in the 70s. It's an issue today. The debt problem wasn't an issue in the 70s. It's an issue today. We didn't have 60-40 portfolios being expensive and, looking for new alternatives. And so to me, I call this a trifecta of macro imbalances. It's the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the late 90s. And I'm very concerned that, ultimately, concerned, but also excited about how to capitalize on those changes. And I think just means that the white line in this chart is going to go much higher. Personally, that's just the way.
Yes. And I noticed your arrow goes up, between $8,000 to $10,000 per ounce. And there, for some reason, there's a bunch of calculations that I can make, gold compared to the M2 currency supply. And there's a whole bunch of them that come out in that range of $8,000 to $10,000 per ounce. When I did my first book, it was $6,000 an ounce. And another thing I want to point out to everybody is that, at the beginning of this third cycle, you can see at the end of the second cycle, gold forms a cup and handle or pan and handle formation. You can sort of see after the end of the second cycle, between the second cycle and the third cycle. So take your cursor and point out that cup and handle, And then we have the handle. It has a triple top on it. There's 3 times, and typically once you've got a triple top where it can't bust through a resistance level, the next time it tries, it blasts through it and it's off to the races. But that is also making, if we have this pullback that we're in right now go for another 3 to 6 months, we'll have an inverted head and shoulders pattern on that handle. So technically, this is an extremely bullish chart. So anyway, let's move on to your last chart here. And yeah, this one is one of my favorites because, when if you want to shoot an arrow the furthest, you pull back the bow the most, right? Build as much tension as possible. So tell us about silver.
Oh, I love the way you said it, because it's exactly what I think it is as well. And I never thought of that way. But monthly chart of silver has been in a downward trend for a while. I mean, since 2011, we've seen this downward trend, and we've had built a resistance line during all these years and decades. And right now we've been kind of hitting on that resistance. And at some point, as we know of resistance, is that they break. And historically, once we see that, knowing how silver tends to be extremely volatile as a commodity as well, we're likely to see an explosive move back to the 50s and at least. And so, this gets me excited. It's why I'm always thinking, how do I not only own silver, but the best ways to really be long this sort of upper pressure on precious metals prices, but particularly silver. It's the main focus I have, and I think it's the cheapest metal on earth.
Yeah, I keep on saying to people, name something else, anything that is selling at a discount to its 1980 price. The only thing you can name is computer chips, and that's because that was a infant technology at the time. But what you see here, if you look at the candles on, there's basically the wick on the candle is the candles are. This is a monthly chart, so it's the open and close for that month, and then intra-week, intra-day swings are the wicks that stick out the top and the bottom. But you're talking about in from 2008 to 2011, going from about $8.25 or something here. I actually think intraday it went down into the 7s, and then going up to 48.50 at that peak, and it didn't even exceed the 1980 high on one of the exchanges in 1980. It hit 52.50, and that was the intraday, and so we have not exceeded the 1980 high yet. But yes, I believe that once this gets over $28 or $30, and it will, with all this energy that is building, then it's a pretty clean move all the way up to 50. It'll encounter some resistance, do a little bit of a pullback probably, but then it'll go over 50, and then that becomes support, I believe. And I do believe that, when you compare it to all of the other things in society and the indices and the currency supplies, I do absolutely believe that silver is destined for triple digits, because that's sort of what puts it back into balance with the rest of the economy. Right now, it is so far undervalued. And I think that when as China slows down, their real estate boom ends. Most silver comes as a byproduct from mining other base metals, copper and lead and zinc and so on. And so as that usage goes down, when they are not building as many apartment buildings and homes in China, and we have a global slowdown, it should end up sometime or another coinciding with some sort of currency crisis where there's a rush toward the monetary metals. So less supply, more demand. That can only be solved with far higher prices.
That's right. I agree 100%. That is my last chart, by the way. So
okay. I want to thank everybody for watching. Thank you, Tavi, for being here, and we'll see you next time.
Thank you, Mike.
Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.